Hello guys, welcome to my channel. The Lazy is more. So today we will discuss an editorial from Indian Express, and it is about the equity and stock exchange. So let's start the editorial directly. I also don't need much about it. We will start reading the editorial directly. The title of the editorial is Power of Retail. As the capital market enters Vikram Samvat 2080, expectations of investors are high amid worries on the inflation and interest rates front, especially the US bond yields. What is noteworthy is the rising influence of domestic investors, especially mutual funds, which have been collecting a record amount from retail investors month after month, despite concerns in the market. This rising power of Indian inflow into domestic equities is a significant development, especially because a large chunk of it is coming from small towns. It is a reflection of a shift in the country's investment culture from conservative fixed deposit to a riskier wealth creation tool. The equity mutual fund this has blunted the impact of outflow of funds by the foreign portfolio investors on the movement of benchmark indices. October witnessed the highest ever monthly SIP inflow of 16,092 crore, while that takes the 7-month aggregate in the current fiscal to 107,240 crore. It follows an inflow of 1,55,972 crore in financial year 23 and 1,24,566 crore in financial year 2022. If October's strong inflow came despite a sudden escalation of conflict between Israel and Palestine, and foreign portfolio investors turning cautious and pulling out funds over concerns of it expanding to more West Asian nations, the strong SIP flows over the last two financial years came even as interest rates kept rising globally, dragging the growth rates down. In October, for example, the FPIs pulled out a net of 28,000 crore from Indian equities between October 1 and November 9, but its impact on the benchmark Sensex has been just 1.5%. Contrastingly, an FPI outflow of 10,836 crore in August 2011 led to the Sensex fall of over 8%. Even in October 2018, an FPI outflow of 28,000 crore led to a Sensex fall of nearly 5%. Why this difference? While the domestic institutional flow led by mutual fund exceeded the FPI outflow by 21% between October 1 and November 9, this year the DII flow in August 2011 was lower than the FPI outflow by 23%. In October 2018 too, the DII inflow was nearly 10% lower than the FPI outflow. The DII strength has come on account of the SIP inflows. If the SIP inflow in October 2008 amounted to rupees 7,985 crore, it more than doubled to rupees 16,000 crore in October 2023. The big chance has come not in large cities but in those that are ranked below 110. Their share in industry asset under management in September 2023 is 18.33%. 10 years ago, the share of these cities in the mutual fund industry AUM on a much smaller base was just 2.57%, and 5 years back it was 9%. The power of retail is enormous, and the flows have been undisturbed by events around the world. War in Ukraine and Palestine, action of the US Fed, rising inflation, concerns over quarterly earnings, and how the bond yields may impact the fund flow. This is building a good set of investors and helping stabilize the Indian markets. Okay. So these are the 5 words that I would like to use. This is for today, guys. Let's find out the 5 new words that I would like to use from today's editorial. The first is undisturbed. Second is tumult. Third is large chunk. Fourth is Vikram Samvat. And fifth is noteworthy. What is noteworthy? Okay, so these are the 5 words that I would like to use in my daily conversation as well as writing. So till then, bye bye, signing off for the day.